Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals as usual. Now, starting with fundamentals driving the US dollar, I would make a start by noting that the USD seems to be supported on all three major fundamental fronts, talking about politics, Trump's intentions to slap tariffs practically all around Mexico, Canada, China in general, any BRIC country which wants to create its own currency, more or less, in my opinion, tends to highlight the dominance of the USD and tends to support the US dollar. On a monetary level, I would be noting that the Fed's intentions about cutting rates in the December meeting are clear. That's not so much of an issue of discussion. However, what happens afterwards remains to be seen. And I wouldn't be surprised to see the bank remaining on hold in its next meeting in January. While more or less on a macroeconomic level, we had the better than expected ISM manufacturing figure, PMI figure, yesterday. It was for November. It was still in contractionary territory, but not as wide as was initially expected. So practically, okay, there was another contraction of economic activity, but the contraction was narrow. And that tended to provide also some support for USD. You can see how Euro USD right here fell yesterday. And at this point, allow me to draw the RSI indicator a little bit lower. That's it. Now, on the Euro side, it's the contrary. Across the Atlantic, we have extensive worries on a fundamental level for the common currency. And first of all, let's highlight the political uncertainty in the area. We had the German government which collapsed, and German Chancellor Scholz has practically called for new elections that they should take place on the 25th of February. But do not consider that even with the elections being held, that will end. Most probably, I wouldn't be talking about a hung parliament, but we may see the discussions between the various central parties which are to take place in order to form a government drag on. I wouldn't be surprised to see a new German government being formed possibly in the beginning of April. So we have a wide period of around 3, maybe 4 months where practically the German government will not be able to take the initiative and drive the German economy out of the slum. It's characteristic that Germans are widely discussing whether there's going to be a reform of the national budget deficit quota. Be advised that in Germany, the constitution has written in it that the German government is not allowed to make a deficit over 0.35% unless there are uncertain circumstances. Say, for example, COVID was such a circumstance, or if the German economy falls into recession. The trick, though, would be for the German government to raise the deficit ceiling, or the deficit floor to be more exact, to lower it even further. And that would allow more fiscal spending on behalf of the German government. It's characteristic that the Germans are facing a crisis on 3 fronts. We have, on the one hand, the green energy transformation, which requires substantial funds. At the same time, I would be noting the economic slump of Germany, given that we have a number of factories which are closing down or are laying off employees. Most characteristic is Volkswagen, which is currently in a strike. IG Metall is striking in the factories of VW. And the third front, in my opinion, would be rearmament. If there's one lesson from the war in Ukraine is that Europe and especially Germany will have to rearm, and that will take substantial funds because the time limit they have is pretty narrow. Now, on a wider view, I would be highlighting also the uncertainty regarding the French government. It's characteristic that French Prime Minister Michel Barnier will be facing most probably a no confidence vote. Such motions have been placed by the far right party, but also the left leaning parties. So I highly doubt whether the French government will survive the no confidence vote, which means practically wider political uncertainty, not only in Germany, but also in France, and that could have a wide effect on the Eurozone as a whole. On a technical level, Euro USD dropped yesterday. Now at this point, I would be readjusting slightly the support and resistance lines, albeit they have not been broken. In my opinion, yesterday's movement showed that the lower movement is available. And let's have it at 0.470. That's 20 pips lower than before. The S2, which is now being placed at 1.0330. And the S3 remains at 1.220. The R1 remains at 1.06, could be moved up 5 or 6 pips, but that's immaterial. The R2 also remains steady at 1.0775. Sorry, 1.07. That could go to 1.0760. Yep. And the R3 at 1.0930. A couple of peeps higher could also be the case, but it's immaterial. So for the time being, we note the stabilization of the pair, given that its downward motion with the downward trend line, which has been guiding and shifting a little bit to the right, but being decisively broken in the past week. So we maintain a sideways motion bias between the R1 1.06 and the S1 1.0470 on a technical level. The RSI indicator has risen and is below, but is nearing the reading of 50. It's actually right now at 41. So there is still some ground to cover. For a switch from the sideways motion bias towards the bullish side, we would require the pair to rise, breach the 1.06, practically form a higher peak than this one, and start aiming for the R2 1.0760. On the flip side, should the bears take over, we wouldn't be surprised to see the pair breaking the S1 1.0470 and start aiming for the S2 1.0330. On a deeper level, and I would say a little bit more extensive, my worries or the risks, in my opinion, tend to be tilting towards the bearish side for the time being. I'm noting what a number of analysts have highlighted, namely that the parity level could be reached by the end of the year or at least mid-January. However, that remains to be seen, and the recent stabilization of the pair tends to disprove such ideas. So once again, we maintain for the time being a sideways motion bias. Let's move to USD/JPY, also make or break pair. And we note that the pair has been dropping once, and then the drop intensified. You can see the divergence from the trend line. It has breached the 150.31. Let's reposition the labels. Sorry. Starting with the S3, which is being placed at 143.45. The S2 at 146.45. The S1 at 149.10. The R1 at 151.30. The R2 at 154.80. And the R3 at 158.35. Now, regarding USD/JPY, I was surprised at yesterday's movement. And it seems like JPY more or less strengthened against the USD in contrast to many other currencies which tended to weaken against the US dollar yesterday. The drop of last week was understandable in the sense that the USD was weakening anyway. So that was explaining the drop of USD/JPY. And on second note, I would like also to mention the hesitancy on behalf of USD/JPY bulls to actually lean over and take the direction of the pair and move it substantially higher. On the other hand, I would be noting that it's also characteristic the fact that the price action tended to stabilize after breaking below the low Bollinger Band right here and has a small green candlestick, which in my opinion is still a correction. I wouldn't be surprised to see the pair dropping once again tomorrow, possibly shifting the downward trend line a little bit to the right, breaking the S1 149.10 and start aiming for the 146.45. Now, what's strengthening the JPY, or at least was supportive for the JPY in the past week, were the expectations, the market expectations for BOJ to hike rates in the December meeting. And it seems that the market is increasingly pricing in such a scenario. Overall, I would be noting that there are hawkish intentions on behalf of BOJ, which could continue supporting the JPY or at least allow it to contrarianly move against the US dollar. Should that having been priced in, because at some point it will have to be priced in fully, or at least substantially, which may no longer have an effect on the JPY, then we may see the USD leading the direction. But for the time being, it's obvious that the JPY is resisting the strengthening of the US dollar, at least yesterday, to a lesser degree today. Should the pair stabilize, because if you note, the downward trend line is being tested right now as we're talking. And it would be interesting if we drill into the 1 hour chart for more detail on this one. Yeah. It's practically moving lower. And stabilizing as it's been hitting a floor at the 149.10 support line. It seems about to breach it. Back to the daily chart. So should the pair clearly breach the S149.10, clearly breach the prevention downward trend line, then I would be switching my bearish outlook in favor of a sideways movement bias, possibly between definitely the S149.10, which is a floor, and the R1 151.30. It used to be a former support line, you can see it right here. But given that the price action has moved below it, it's now turned into a resistance line. For a bullish outlook, I would require the pair to not only breach the prementioned downward trend line signaling the interruption of the downward motion, but also to breach the R151.30 and start aiming for the R2 154.80. Let's have a look at cable. Sorry. It's quite interesting if we extend this downward trend line. That could imply more or less that the downward motion bias is still present for the pair. But in my opinion, I see it stabilizing. And it seems that it's stabilizing with the price action of USD/JPY revolving around the 1.2675 level, a level which used to be a support line. You can see the throw here upon which it rests. For the time being, it has breached above it. So we're turning it into support line, however, that's quite uncertain. Replacing the R3 and correcting its contents at 1.3260. The R2 at 1.3040. The R1 at 1.2845. The S1 at 1.2675. And the S2 at 1.2515. Finally, the S3 being placed at 1.2295. By the way, should you have any questions, or if you would like to have a look at any other trading instruments we're offering, feel free to add them in the chat box. We'll have a look at them today. If not, we can always have a look at them tomorrow. Once again, for the time being, I tend to maintain a bias for a sideways motion for cable, given that the price action has narrowly just broken above the 1.2675. Yet bearish tendencies may reemerge, and the bearish outlook is being supported practically by the downward trend line. The 20 moving average, which is rolling down, you can see the blue line right here. And also note how the 50 moving average has turned bearish. So we have a bearish cross where the 50 moving average is crossing over and below the 100 moving average. Should the bears take over, I wouldn't be surprised to see the price action breaking the S1 1.2675. Yet for bearish outlook, I would require the pair to also breach the S2 1.2515. I'm requiring practically a lower trough than this one. So a clear break of the S2 has to happen before I switch my outlook into bearish one once again. On the flip side, should the bulls take over, then we may see the price action rising, breaching the prementioned downward trend line, which would be signaling exactly the end of the interruption of the downward motion. But I would also like it to break above the 845, which would allow us also to draw an upward trend line showing us the limitations of a possible upward movement. USD CAD. Now, in my opinion, the stabilization of the pair is clear, and I maintain a bias for a sideways motion between the 1.4088 and the 1.3945. Despite some being willing to shift the upward trend line to the right, I'm not prepared to do that, and I'm actually considering the upward trend line as having been broken. It's characteristic also that the pair has failed to form a new higher peak, and at this point I think the 1 hour chart would be of more interest. You can see the peak here, and the next one is lower. Interestingly enough, if we drill into the 4 hour chart, this peak is nearly as high as this one. Anyways, the stabilization of the pair, in my opinion, is in play, and the levels, the boundaries set for the range bound movement are the R1 1.4088 and the S1 1.3945. A breach of either of the two pre-mentioned boundaries could be signaling more or less a new direction. Say, for example, if the price action of USD CAD breaches above the R1 1.4088, then it will be aiming practically for the R2 1.42, and that would allow us to renew the upward movement, or if you prefer, renew the bullish outlook. On the flip side, should the bears take over, then I wouldn't be surprised to see the price action of the pair breaking the S1 1.3945, proving that this was merely a peak, and start aiming for the S2 1.3820. Moving now to the Aussie, and the Aussie is a very, very interesting pair. Let's reposition the label so we get a clearer view. Now the Aussie is, in my opinion, caught between conflicting fundamentals. On the one hand, we have relative disappointment from the weakening of the Chinese yuan yesterday and during today's Asian and early European session against the US dollar. I think USDCNH has reached monthly highs, and in my opinion, it was interesting how the PBOC allowed for the Chinese yuan to weaken. I think that I wouldn't say lack of recovery, but the pace at which the recovery of the Chinese economy is being delivered or performed is disappointing. We had the NBS manufacturing PMI figure for November and the Caixin manufacturing PMI figure. The latter was a little bit better than expected. But overall, I tend to maintain my doubts in the following sense that given the fiscal and monetary easing, which we saw from PBOC and the Chinese government over the past 2 months, I would expect a faster, or if you prefer, an accelerated, a wider expansion of economic activity for the Chinese manufacturing sector. And I'm a bit disappointed. I would expect more. And I think that's something which also Aussie traders are keeping an eye out, given that Australia and China have very close economic ties. China is importing from Australia a wide amount of raw materials. And as long as the expansion of economic activity in the Chinese manufacturing sector remains, I wouldn't say unchanged, but relatively slow, then I would be noting that most probably we may be seeing also the Aussie being under pressure. On the flip side, AUD is supported on a monetary level. In my opinion, RBA is prepared to keep rates at high levels for the next 2 sessions, for the next 2 meetings, at least. And the interest rate differential outlook of RBA to other central banks of major economies such as the Eurozone or the US or the UK, which are considering of lowering rates further, tends to be supportive for the Aussie. On a macroeconomic level, I would be highlighting the release of Australia GDP rate for Q3. It's due out in tomorrow's Asian session. And should the Aussie more or less show an expansion of the Australian economy, maybe even at a faster pace than expected, that could provide support for AUD. I wouldn't say in an asymmetric manner, but still substantial one. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
In progress. Okay, hi everyone, welcome to today's webinar. So for today's session, we are going to be talking about price action. We're going to give about 1 more minute to let more people join the session before we get started. So in the meantime, let me know in the chat if you guys can see me and hear me, and can see my slides as well. And then we'll begin in about 1 more minute. Thanks, everyone. Okay, let's go ahead and get started. So, as per usual, a risk warning and disclaimer, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst from Rocket, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We're going to start off by talking about the anatomy of a candlestick, some price action trading approaches, and then we'll look at the different candlestick patterns. And then lastly, we'll combine candlestick patterns with what we already know, such as your support and resistance, your Ichimoku, and some other indicators as well. If you guys have any questions throughout the webinar, feel free to let me know in the chat, and I'll try my best to answer all of them. Okay, let's go ahead and get started with the anatomy of a candlestick. So here's we have a bullish and a bearish candlestick. On the left, we have, so basically the tip of the bullish candle is the high price, and the close price starts when at the start of the body of the candlestick. If we look at the lower wick, the open price starts at the bottom of the body and ends at the lower price, which is at the end of our candlestick. So obviously the opposite is true for our bearish candle. Your high price would be at the top of your upper wick. Open price would be at the start of the body of the candlestick. Close price at the end of the body of the candlestick. Low price would then be at the bottom of your lower wick. So here's our price action trading approach. Okay, we have the reversal and the breakout. So here's an example. We have price moving within a ascending trend channel. Okay, and we have what's called a morning star formation right at the tip of our um at the lower band of our ascending trend channel. Okay, so when this morning star formation starts, we are expecting a reversal to continue within the ascending trend channel. You can see that's exactly what happened here. Okay, next, let's look at the breakout. So we have this area here, this resistance area, which is with one swing high, swing lows, and a couple of swing highs. So basically, when there are bulls and bears that respect that area, or there are swing lows and swing highs that respect that area, it's basically called an overlap level. And this is a very strong resistance area where we are expecting price to break through. Okay, and you can see exactly that's what happened here as well. Okay, and how do we know that price is going to break through? Basically, from again the formation of your candlesticks. Here we have what's called the three white soldiers. So there are many formations of candlesticks out there. So if you just Google, there will be many templates that you can take a look at. So you don't really have to remember off the top of your head the different shapes or formations of these candlesticks. Just as long as you are comfortable using a couple of them, you can always refer to Google for any templates or any guidelines on the different shapes for candlesticks. Okay. Okay, so moving on, we can see after this three white soldiers, price broke out really strongly and rose above our resistance area. Okay, so before we get started and we dive into the different candlestick patterns, this is basically what price action is. So it's basically the movement of a security's price. In this case, would be Forex. Plotted over time. So that's why we are looking at specific candlestick patterns or which tell us the price movements without relying on the different indicators or even algorithms. So it's all about understanding the market's natural behavior. Okay. And then we'll show you at the end how to combine these natural market's natural behavior, which is then our price action, how we combine that with our indicators so that we get a greater understanding of the direction of price. Okay, so let's get started. So we're going to start off with the three single candlestick patterns. We have the hammer and the hanging man, which are just opposite of each other. Okay, secondly, we have the inverted hammer and the shooting star. Again, these are just the opposite of each other. You can see the difference in the shapes. So the upper wick would be a lot smaller on a bullish or a hammer. And your lower wick would be a lot longer. Whereas for your hanging man, we're looking at a bearish candlestick, but looking at the same shape. So again, this is a bullish candlestick. This is a bearish candlestick. If we look at an inverted hammer and a shooting star, again, you see the shape of the candlesticks are exactly the same. Here, we don't really have a lower wick that we're looking at, which is mainly the body of the candlestick as well as the upper wick. So for both of these, this is a bullish candlestick, that's why it's green, and a bearish candlestick, but exactly the same pattern. Okay, and next we have the dragonfly doji and the greystone doji. Okay, so again, we can see price moving or rather these candlestick patterns are exactly the same. It's just that in this case, we are looking at a bullish candlestick pattern, and over here we're looking at a bearish candlestick pattern. Okay, next, let's look at the top two double candlestick patterns. Okay, so here we have bullish engulfing and bearish engulfing. So again, like we mentioned earlier, we have the exact kind of same pattern, just that one is moving upwards and one is moving downwards, since it is bearish. Okay. Okay, so let's move on. Here we have the second double candlestick pattern. So for this one, we are looking at tweezer bottoms and tweezer tops. Again, the candlestick patterns are exactly the same. And it's just that we are looking at the price looking at a reversal from down to an up trend. And on our tweezer tops, we're looking at a reversal from the uptrend to a downtrend. Okay. Next, we're looking at our top three triple candlestick patterns. Here we have our morning star and evening star. So our morning star is kind of a signal that price is going to reverse again, similar to our engulfing pattern. If I go back, rather similar to our tweezer bottoms, you can see when we are able to spot a morning star, price is reversing in its trend. Evening star, similarly, it's also reversing in its trend but giving us a bearish direction instead. Okay, so for the morning star, it's typically occurs at the end of a downtrend. That's why we say it's a reversal. So the first candle, which is this red one, it's a long bearish candle, which indicates a strong downtrend. Okay, whereas our second candle tends to be a smaller shape, can be bullish or bearish actually, that gapes down and it shows indecision in the market. So this can be your doji or even a spinning top that we talked about earlier. Then your third candle, which is this green one here, would be a long bullish candle that closes well into the body of the first candle, signaling a reversal. So the pattern is actually more reliable when this third candle here, when it closes above the midpoint of the first candle. So you can see the midpoint will be somewhere around here. So if it closes somewhere around here, that's a good sign that price is going to continue in the uptrend. Okay, so obviously the opposite is true. For an evening star, we have a long bullish candle here, indicating a strong uptrend. Then we have that same doji candlestick here, showing indecision in the market. And then the last candlestick is basically a long bearish candlestick that closes well into the body of the first candlestick, which we see the same thing happening here. Okay, let's move on. Okay, so next we have the three inside up and inside down. Here we have a opening candle, which is a bearish candlestick, and followed by a green bullish candlestick, which is much smaller. And the opposite is true for a three inside down. Okay, so again, these are indicators of potential market reversals. That's why for our inside up, we can see a downtrend reversing up into an uptrend. For our three inside down, we see an uptrend turning into a downtrend. So for three inside up, we would see a first candle giving us a long bearish candle, indicating a strong downtrend, and then followed by a smaller bullish candle that is completely contained within the body of that first candlestick. That's why you see it completely within this area here. Third candle would be a long bullish candle that closes above the high of the first. Okay, so that confirms your reversal into an uptrend. Okay, opposite is true again for your three inside down. So starting off, we have a long bullish candle, which indicates an uptrend, strong uptrend, and a smaller bearish candle here that's completely contained within the body again, confirming. And then lastly, the long bearish candle closing below the first candle, confirming the reversal. Okay, we have a question here. What time frame do you see good setup for signal? Okay, so the time frames that we normally would use for these candlestick patterns is completely up to you actually. Um, we just normally like to do our analysis on swing trading. So that will be like your medium term trading, we're looking at 4 hour to your daily charts. You can also go down to your shorter term trading if you are a day trader, or your intraday trading, which would be about 30 minutes to 1 hour. We typically won't recommend you to go below 15 minutes just because it tends to get a little bit too noisy on those shorter time frames. Um, but yeah, especially for candlestick patterns, it doesn't really matter which time frames you use. Just yeah, those are just the ones that we normally like to use. Would be 4 hours daily, 1 hour. Yeah, but the lowest we will go is 30 minutes. Okay, it will probably be easier for you to catch these reversals for candlestick patterns on a shorter time frame as well, because patterns on the shorter time frame, so like your 30-minute and 1 hour charts, can kind of provide you multiple trading opportunities throughout the day if you are looking at intraday trading. So those might be better for candlestick patterns. Okay, so now let's look at combining candlestick patterns with what we already know. Okay, we're going to start off with support and resistance, followed by our trend lines, oscillator indicators, and momentum indicators. Okay, let's get started. So again, if you guys have any other questions, feel free to let me know in the chat. Okay, so support and resistance is basically the price at which an asset's price tends to stop falling, which would be your support level, or stop rising, which would be your resistance. So you would identify these levels using technical analysis tools such as your trend lines, moving averages, and chart patterns. And these would be your swing highs or your swing lows. Okay, so here's an example. This is just a really quick recap on your support and resistance so that we can kind of go through how to identify these levels with your candlestick patterns. Okay, so here in this chart, I have drawn out our swing highs and lows for you to look out for. The swing low would of course be your first support, And your first resistance is basically the level that is closer, the swing high that's closer to where price is currently at. Okay, next. So here's an example of an insignificant swing. So these levels are bad to use um for Fibonacci points. Here we're talking about Fibonacci, but they are bad to use for any kind of resistance or support levels that you're looking at. Okay. Yeah, here's another example of insignificant swings. Okay, so you can see there aren't really any clear patterns here. No real swing highs or swing lows. Okay, and here is an example of significant swings. So there is a very clear move up and down with obvious peaks and troughs and a very clear market movement. So these are really good levels to use for your support and resistance. And they're easier to spot for your candlestick patterns as well. Okay, someone asked, what's the need of learning candlestick types and what roles do they play in trading? So they actually play a pretty significant role. Firstly would be each candlestick kind of encapsulates a lot of information about the price action within a given time period. So like we went through at the start about the anatomy of your candlestick, it includes the opening, the closing prices, the high and the low. So it tells you what the sentiment of the market is as well. So for example, a long bullish candlestick would suggest a strong buying interest, while a long bearish candlestick would then suggest stronger selling interest. So that would probably be more useful on your shorter time frame. Again, most of these, I can't tell you whether it's useful for you as a trader, because everybody has different strategies and trading techniques. But yeah, it is still important to know the different patterns. Okay, because like we went through the different types of candlestick patterns or the top ones to use, those can help you to identify the beginning or the continuation or reversal, so on and so forth, or the ending of trends, example. So like I think just now we went through a bullish engulfing pattern. So that would indicate the end of a downtrend and it might indicate a reversal to an uptrend. So that allows you to predict future price movements based on your historical data as well. Okay, so yeah, so all of the webinars that we have, like, and all of the tools and strategies that we give you might not be applicable for you personally as a trader, but it helps to have multiple tools so that you can confirm your indicators, by using your trend lines, all of these support and resistance levels as well. It just basically helps to confirm your analysis. Oh, and another important thing would probably be that the candlestick patterns can help you to determine your optimal entry and exit points as well. So that's why we're going through this resistance and support recap as well. So that because resistance and support levels are often really good levels to use for your entry and exit points. So these candlestick patterns further help you to determine even better points as well, especially if on these support and resistance levels, you can spot a pattern, candlestick pattern there, then it further confirms your analysis. Okay, we have another question. Let me see. On a bearish setup, is there any white soldier candlestick which will indicate that there's possibility for support breakout? Um, The three white soldiers typically refers to a bullish setup. On a bearish, in the bearish context, okay, maybe let's go back to my slides. I can't really remember the patterns off the top of my head as well. Um, Yep, so for bearish, we would be looking at the three black crows for a bearish setup. Okay, I hope that answers your question. So these are just basically three consecutive long body bearish candlesticks with progressively lower closes, indicating a stronger bearish sentiment. Okay, so the opposite of a three white soldier candlestick pattern. Okay, so for example, once you're able to spot this pattern, you might want to use your momentum indicators like your RSI or MACD, for example, which show you if they show you a bearish divergence or moving into oversold territory, that can signal weakening bullish momentum and potential for a support breakout. Okay, okay. Let me get back to my slides. But yeah, let me know if you guys have any other questions. So here's an example of significant swings. Very clear market movement here. And support and resistance. So these levels, as I mentioned earlier, are used as your take profit, stop loss levels, entry, exit, so on and so forth. But an important thing to note is to make sure that your swing highs and lows, there are multiple swing highs and lows that line up together so that it strengthens your entry and exit levels. Okay, so there are at least two swing high or low levels that line up nicely. It's a much better level to use. So that's why we want to try and find levels where these might line up. So it doesn't have to be exactly at the same level, as long as it's near, that's good enough. Okay, so let's look at how to pick your starting point for your support and resistance and your entry exit levels. So when picking the starting point of pivot, entry, support, resistance levels, there are a couple of rules. Firstly is to check if there's a swing high or low, pullback or overlap level to start from. Next is to go back as far as possible without intersecting too many bodies of candlesticks. Okay, so we have some swing highs here, where the price, or rather where the resistance level cuts the wick of the candlesticks. That's fine. Over here, it's kind of cutting the bodies a little bit, so that's not too preferred, but that's fine as well. So some more examples here. Okay, you can see when it cuts through nicely just one body of the candlestick, that's fine. This is something that we want to avoid because it's cutting too many bodies of candlesticks. Okay, we just want clean cuts of just the wick. Okay, here's another example. Take note of this red highlighted area because we want to avoid intersecting so many candlesticks. Okay. Okay, now let's look at the pullback and the overlap. So I did kind of mention the overlap earlier, but a pullback support is basically before an overlap occurs. So it's a strong level of support and resistance, and it breaks out from previous resistance level, and price is now dropping back to visit it again. So when a pullback support level lines up with a Fibonacci level, it's very powerful. And these levels are also made powerful when you are able to spot a candlestick pattern as well. So this works well when it breaks a significant swing low and then starts pulling back to it. It's even better if there are multiple Fibonacci levels that line up with it. Okay, so now let's look at the pullback resistance. We have some swing lows here. Okay, we have three swing lows here, and price is breaking below the swing lows, and we're looking at it, we're expecting it to hit towards that same level and reverse off of it. Okay, that's exactly what a pullback resistance is. Now for pullback support, we're looking at a resistance. So here we have three swing highs, making it a pretty strong resistance level. And then price has broken out of the swing high resistance. Okay, so it's broken out of it, surpassed it, and now we're expecting it to reverse back to that same level. Okay. Okay. I'm just gonna Okay, so now let's combine our pullback and overlap levels. Okay, I already mentioned the pullback support earlier, so let's talk about our overlap levels now. So an overlap level, like I mentioned earlier, is basically when price comes back to it like this, um, and it actually reverses off of it. So when we have a swing high and a swing low that line up nicely, that's an overlap. Okay, so here we have a big swing high resistance here. The moment price surpasses the swing high resistance, it becomes a pullback support. Okay, and once we see price pull back to that pullback support level and bounces off of it perfectly, that then becomes an overlap support. Okay, here's another example. We have a couple of swing highs here. Okay, and price breaks out of the swing high resistance and pulls back to it. So once price breaks out of it, it becomes a pullback support. Once price pulls back to it and bounces off of it, then it becomes an overlap level. And once price bounces off of it again, it now becomes an overlap support. Okay. Okay. Another example. So here there are multiple swing lows in line at the 33420 level. And once price breaks this level, it then becomes a pullback resistance. We can see price has tested this level 3 times, making it a strong overlap resistance level. And we can see price surpass this level again to become a pullback support. Lastly, it tested this level and bounced off of it, becoming an overlap support. Okay, so now let's combine all of these with our trend lines and price action. So here's what a trend line is. Just to recap, as it's a valid trend line if there are at least 3 touches on it. So we have one swing high, two swing high, and actually four swing highs here. Okay. Here we have price moving within an ascending trend channel with multiple swing highs again and swing lows. So what makes it a valid trend channel is if there are 2 touches, minimum 2 touches on top. Here, of course, we have three. And at the bottom we also have three, but at least 2 touches on top and below, that's good enough. Okay. So here we have price moving below or bouncing off our Ichimoku cloud. And here we have a swing low support, price breaking out of it, and we are expecting price to um, continue to bounce off of it. Okay. Okay, are there any other questions? Okay, if not, there was a question about the um which I think there was a question about the time frame. So let's briefly go through that as well. Okay. I just wanted to talk about which time frame to use, just really quickly. So here's an example of price. You can see it's um kind of messy. There isn't really a very clear market structure. And this is on our M15 chart. Okay. Now, if we change that and we look at it on an H1 view, the exact same chart, just on a different time frame, you can see the market structure is a lot clearer. Okay, so the thing to learn here is that at the very basics, the clearer the swing low and the clearer the swing high, the clearer the trend between these 2 points, the more accurate your analysis will be. Okay, so it doesn't really matter which time frame you use because that's very dependent on your own lifestyle and your own trading methods. But yeah, as long as you make sure that your market structure is clear, that's fine. Okay, so yeah, so typically traders will choose at least two time frames, such as your short-term time frame and longer-term time frame. So like I mentioned, we don't go below 15 minutes because it's kind of how can I set YouTube? Okay, so let me get into that in a bit. But basically we don't go below 15 minutes because the charts tend to be a little bit too messy on those time frames. So your short-term time frame is used to identify the most recent trends and price movements, which is why again just now I mentioned that we if you look at your price action, so like your candlestick patterns, those tend to work better on shorter time frames. So like your 30-minute and 1 hour time frames, maybe even 4 hours. Okay, but your longer term time frames will be used to identify the overall trend and market direction. And again, we will use all of those together with key support and resistance levels, trends, patterns, indicators. Okay, so what we look out for on the higher time frames will be key graphical levels. Those, this horizontal levels that we're talking about are those that we just went through. So your support, resistance, pullbacks, overlaps, all of those. Trend lines, trend channels that we also just went through. Some breakouts, big moving averages. These big moving averages and Ichimoku, those are your indicators that you would use after doing all of this technical analysis. Big Fibonacci levels, those are those we cover more in depth in our Fibonacci series. And lastly would be your price action, especially the prior bar. So this is what we're talking about today, what I was talking about with the candlesticks and all of that. Okay, let me just answer some of the questions now. Um, okay, I can show you how to set up Ichimoku in a little bit. What is a 3 super trend indicator? And does it work on MT4? So the super trend indicator strategy, this kind of um not really related to today's topic, but it's basically it follows the trend, obviously, and it's based on the ATR and closing price. So ATR is your average true range, and it helps to determine the trend of the market. So of course, there's an uptrend when the price is above your super trend line, and downtrend when the price is below the super trend line. Does it work on MT4? I'm not super sure. I don't think the mobile app supports custom indicators like that. But I'm not too sure. Maybe it works on the desktop instead. Um, yeah, maybe you can check on that. Because I think super trend indicators are custom indicator, and your MT4 mobile app cannot set up custom indicators, if I remember correctly. Okay, setting up Ichimoku on your phone or laptop. I can show you how to do it on TradingView. Let me just open my TradingView. Okay, so if this is just a random chart that I have open, if you click on these indicators, and search up Ichimoku Cloud, okay, yeah, it show up like that. It might not show up like this actually. Let me, okay. So this is your Ichimoku Cloud, okay, and basically you just click on indicators, search up Ichimoku, and this is what it look like. Click on settings, and there's actually a lot of different lines when it comes to Ichimoku. I'm not going to go through in depth what they each represent now, but I'll tell you that we normally just look at the cloud. Okay, so we normally just look at the plot's background. If price is moving above the cloud, it's a bullish signal. If price is moving below the cloud, it's a bearish signal. So that's one of the quickest ways to use Ichimoku. Yeah, so this is on TradingView, if which you can use on your phone or laptop as well. So for Fibonacci, which I didn't really have time to talk about in depth today, but I did kind of mention it in our price action. So you can take a look at this website. Um it's a free website to use. It's just the forexarmy.com. You can look at some free videos that we have on YouTube on retracements, extensions, some guidelines. Yeah, so what are the different levels that we use, how to use them, how to draw it so that it's valid, how to avoid invalid levels, negative levels as well. Because we use 4 different techniques when it comes to Fibonacci. So stay tuned for our Fibonacci webinar series. It's a 4-part series, and we go really in depth into each of the Fibonacci techniques as well as different examples. But in the meantime, you can take a look at this as well, in case you were curious, since I did mention them a couple of times in today's webinar. Yeah, I think that's it for today. Um, yeah, let me know if you guys have any other questions. If not, that's all for today's session. Thank you guys so much for joining me. I hope you guys found this session helpful, and I'll see you guys again next week. Thanks, everyone. Bye.